Ladies and gentlemen, welcome to another edition of Independent View with your host Lobo Tigre of the Independent Speculator. Our guest today is Gareth Soloway. He's the CEO of InTheMoneyStocks.com. I've never met Gareth before. I've seen him in interviews on Kitco and other places. You may have as well. And honestly, his people reached out to me and I thought, I want to talk to this guy because the times I've seen him, he has seemed less pie in the sky of the technical analysts I see out there, very probabilistic rather than predictive in his statements. And it's just my pet peeve, people who get on there and say, oh, the market's going to crash next week. And then they're wrong. So I like it when somebody is probabilistic, that the signs are the market may crash next week. So with that intro, Gareth, why don't you tell us a little bit about what you do and how you do it? And then I've got a bunch of questions because probabilistic and all, I'm still not sure I understand what you do.
Totally understandable. And thank you for having me. It's such a pleasure to be here. And I love, coming on a show where people want to learn, where they're kind of curious, where they don't necessarily believe it. I think that's everything, right? I mean, there's so many things in life that we don't understand, and it's that will to learn or at least think about it that I think is very, very important. So I am a technician. Like you said, it's all about probabilities. I don't get these people that call for crashes next week either. That's literally impossible to do. What the charts do is they give you support resistance points where you can basically say, okay, historically, when you hit this line or this point, the odds favor this move, right? So it might be 60-40, it might be 70-30, but that's really what the charts are doing for you. It gives you that slight edge. And the idea behind the slight edge is that if you do 1,000,000 trades or 1,000 trades, and if you can win 70% of the time, you're doing pretty darn good in this market or in any market. So that's really what it is. I keep it very simple. I just look at charts. I don't use a lot of these crazy indicators, MACDs, stochastics, and all that stuff. I literally just look at the charts and I look for repeating formations, right? So where did the chart hit last time where it bounced? Where did it go to where it pulled back to? Is there a trend line if I connect A, B, and C that is a straight line? Does that give me a level to watch for either a bounce at that line or a breakdown at that line? So that's really what it is. And again, I think it's important to recognize that there's no perfect science in investing. Anything can fail. I've had plenty of losers out there and I've had plenty of wrong calls, but I'm still doing this now for over 20 years because I've been able to kind of get the odds in my favor by a little bit.
Okay, well, that's an excellent way of framing it. And I have several thoughts to dive into, and I hope I'll remember them all. But the first one is, okay, but most people aren't doing, well, okay, we have day traders, and I assume probably not many in my audience, not sure about yours, are high-frequency traders, but most of my readers are, resource investors. They want to find a company they believe in, buy it, and hold it until that hockey stick delivers. They're not day traders. Right. So does what you do apply at all to them? I mean, how useful is that technical analysis to a value, a value speculator, if you will, in the resource sector?
Yeah, so I think it really is a value. For instance, in the resources, there's been some beautiful bullish patterns developing in gold. And I've been, believe it or not, in December, I said that the best performers in 2021, or the best performer when you compare Bitcoin, the stock market, and gold, would be gold. And it was because of chart setup patterns there. In fact, let's take a little bit of a look here on on gold. And I will do my best to kind of walk you guys through. So I'm going to do a quick screen share here. Hopefully everyone can see. Can you see there?
I can. Thank you.
All right, wonderful, wonderful. So basically, everyone's been ripping on gold because, hey, gold hasn't done anything for the last year and a half, almost 2 years. But what people don't understand is that when you have a big move up like you saw from 2018 to 2020, you need a period of consolidation. I always liken it to a marathon runner, right? A marathon runner runs 26 miles and change. You can't say, hey, go run another 26 miles and change right afterwards. They need that time to recuperate, digest their run, and kind of get energy again. And that's the beautiful thing about this. This would be known as a big move up and a bullish consolidation. And then what you notice here is that if you just connect these recent highs and these recent lows, they all align. So based on that, knowing that the bigger pattern is a consolidation or a pause, and seeing that the smaller pattern is now breaking above that level, it gives me the probabilities to say, okay, gold is now potentially breaking out. Gold looks like it can maybe trade at least back to the 2020 highs of around 2075. I'm a big fan as well of history, right? So history, I do believe that history doesn't necessarily repeat, but at least it rhymes. And what I'm fascinated about is that a lot of people will go in the charts and they'll say, well, you have all this inflation. Why isn't gold ripping up, right? Why isn't gold just going to the moon? This doesn't make sense. And what I do is I like to go back in history. And before I do that, just remember this. So 2 years from 2018 to 2020 up, and then almost 2 years of consolidation here. And what we're going to do now is go to the weekly chart, and I'm going to go all the way back to the last time we had incredible inflation like we see today in the 1970s and 80s. And what you can see here is that from 73 to 75, you had a sharp up move. And then look, you had 2 years of the same thing that we're seeing now. Now, following that, you had that same sort of breakout that maybe we're starting here, and look at the move up in gold. So again, it's very important to kind of look historically, kind of match things up. It doesn't guarantee, again, that it's going to be exactly a repeat. In fact, I'd be shocked if gold percentage-wise does the same sort of move that it did then. But, is it possible that gold could go from 2,000 to 4,000 an ounce in the next couple of years? I think very, very likely, especially if you're in my camp where you think inflation isn't going to go back to 2%. So I think these are the things that I look for in the charts. I look for shorter term pattern formations, longer term, and then I also like to go back in history and kind of see what is going on in that respect.
Right now has to be the Russia-Ukraine situation. There's no way the markets saw that coming. I mean, is that relevant, or is that a reason to actually say, well, let's not put too much weight on this breakout because it's exogenous?
Yeah, so that's a good question, right? Definitely there's some turmoil that can happen that can create these moves in gold. From a TA perspective, the chart was telling you something was rumbling, right? And if you look at what Russia's been doing over the last year or so, you could arguably say, this was a likely scenario. They've been massing troops for quite some time. So I definitely understand that aspect of saying, well, is the news just creating the pop? The other thing I'd like to point to is a lot of people were telling me 6 months ago that when yields go up, gold usually goes down, right? I mean, I've heard that so many times. But then the question is, well, yields have gone up tremendously from like 1.2% maybe 6 months ago to 2% plus on the 10-year. So why hasn't gold gone down? And the key is understanding that when yields go up because of a strong economy, then de-risk or risk on takes place and people sell gold. When yields go up because of inflation, then gold will follow suit in general. So again, I think it's important to kind of recognize what's going on. In terms of the news specifically, I'm kind of a believer that the charts know ahead of time, essentially big money knows. And so the big money's already positioning themselves. They have these people, they spend billions of dollars a year researching, understanding, having people positioned in the right spots, and so that they can get ahead of all of you and me in terms of the moves, and then therefore this is just what they've been accumulating for.
That's interesting. I confess I hadn't thought of it that way. I'm thinking, there's no way the average futures contract trader on the COMEX knows what Putin's going to do.
Right.
But the big money in the world, the really big money in the world, those people and you could have access to a different level of information.
You could also argue that, I mean, and people, so Friday we heard about the news break that, Russia was inevitably, could be even last weekend invading Ukraine, right? And it came out Friday afternoon. And if there's one thing I've learned in my 20-year career, it's to not trust news that's leaked out on a Friday afternoon. Because what does it do? It panics every investor, small investor. They sell because it's the weekend. They can't sell over the weekend if it happens. And then lo and behold, I even said this on Friday, watch, something will happen. They'll walk back this information. And sure enough, Monday morning, we heard Lavrov walk it back. And then we've seen in just the last 24 hours, troops kind of leaving the front lines. So, these type of things you have to, as an investor, be ready for. And that's why I like to trust the charts. The charts are the purest way for me to see into the probabilities of what could happen. And the news tends to make you have an emotional reaction, and the charts keep you grounded. They keep you logical. It's the chart says this, I do this.
Okay, so before I lose one of the earlier thoughts I had based on what you started to say here, in terms of looking back at price points, how do you do that? I actually would, I don't consider myself a technical analyst, but I do something like that informally. I certainly look at price points. If I'm looking at buying something, and it has a chart like what you've got right there with gold, and I look at, well, gee, it's gone down to this level, like on your chart, say just around 1750 or above that, multiple times over the last few months. If I'm looking to buy, and that's what recent history is telling me is the floor area, well, then that's where I want to buy. And so I'm looking at a stock more than bullion or something, and I'm saying, oh, gee, last 6 months, it's dropped to this price level multiple times. Gold hasn't broken out yet. Well, until last week, gold has, nothing has changed in the market. So why would I pay more? Right. Why not wait for that lower thing?
But you're using TA. That's the technical analysis.
You might be hurting my feelings there, Gareth. I think of that as sort of fundamental. I'm a value investor, and I'm looking at the fact of where people have been willing to buy and sell. And I don't put a line on the chart, but I do look at that. If people have been willing to sell at that price multiple times in recent months, why should I pay more? That's the way I see it.
Right. Right. And you're 100% right. And to be honest, that's very similar to what I'm doing. I'm just drawing the trend line so I can see those levels. But that's exactly what you would do. And then, for me, I say, okay, well, now it's showing. And by the way, when it keeps bouncing off of these levels, it's telling you more than just, okay, there's a line there that's magically creating a bounce. What it's telling you is big money is buying there, right? And what I love about gold is that when Bitcoin was running in 65, 69,000, and there was money that was leaving gold. There was no doubt about it. People were dumping gold to go into Bitcoin and cryptocurrencies, but gold never really had a big drop, which told you again that big smart money was buying. So again, these are the types of things I really want to just position myself with the big money, because they're 95% of the time going to be right if they are that big money.
All right. So let's just for the moment, and I don't want to just talk about gold only, and I do want to dig more back in the TA, but just on this chart and talking about gold with this breakout we have here right now, what does your experience say? A triangle like this, a converging triangle, what does that tell you? The odds are, never mind the Ukraine breakout, but just that triangle itself before the breakout. Yeah. What does that tell you? Is if it does break out without war, is that what's the probability of it going up or down here?
So once you break out and you hold above the level, so occasionally what you'll see on a technical analysis chart is you'll see it go above and then it'll go back below. And that's what I call a fake out, where, it was more to get investors on the wrong side thinking it's a breakout. But once you stay above it like this, I'm pretty firm on the fact that you're likely going to see more upside. Now you're going to have stopping tools along the way.
Let me jump in. Let me jump in, Gareth, and ask you. So a fake out to get people to buy, that implies a rather deliberate market action. Are you saying that there's big money out there that will actually chase a price higher than they would normally pay to cause a market reaction to then be able to buy in later on the retreat? Or is it that, are they that Machiavellian?
They are. I mean, this is incredible stuff, but there's absolutely, in fact, if I go to Bitcoin's chart, take a look at Bitcoin's chart here, right? So let me get rid of this little, and we'll talk about that in a second. But there's a technique I developed, and this is something I actually developed. It's called the confirmation signal, which basically tells you if it's a confirmed breakout versus a confirmed versus a fake out. So is it a real breakout or is it a fake out? And what you saw here was just absolutely amazing price action on Bitcoin around 65,000. So what we want to do here is let's draw a trend line right through that April high. And what you saw here on Bitcoin, see how it got above the line and it never had a second. So the confirmation signal says that when you close above a key trend line, you need a secondary close above that high to really confirm it. And the reason why this works is because institutions will put a little bit of money in a trade, but they're not going to commit millions or billions of dollars if they're going to fake it out. So what they do is they close it above, and then the next candle dips it back down. And then look at here, again, they did it again. Did it ever close above that high? It pierced, but it never closed above. Ultimately here again, and then look at price to the downside. So I know it sounds crazy, but we do need to understand that there's a lot of money at stake, whether it's options expiration money. And this is another thing that investors need to understand, is that 95% of all the options, whether it's crypto options or if it's stock options, they're sold by institutions to retail investors. All right. So the institution takes a premium for selling that option, right? They get a premium. Now they maximize the profit if that expires worthless, if that option contract expires worthless. So there's an incentive, and they have computer programs that will run an analysis and say, okay, we need to close Apple at XX price to maximize our profit and have the most options expire worthless. And that's where we maximize our gains. So, I mean, to think that there's not these kind of little things that go on in the market, I think is being naive when there's billions and billions of dollars on the line.
So that brings to mind another question. It's one reason why I'm not a TA, I guess, or I have not thought of myself as one, and more as a value speculator, because, how is little old me or the average investor out there going to compete with JP Morgan and all these guys? I mean, people like to hate JP Morgan. But the fact is they exist, and they do have billions of dollars and, millions into the hardware and the high-speed access to the exchanges and the data far faster than we can get to it. So the idea that I'm going to draw some lines on a chart and figure out something that, Goldman Sachs and JP Morgan and all these wonderful people haven't seen or haven't prepared for or even created, it strikes me as a little Pollyanna. I'd rather, if I'm right that gold's going up this year, and I buy gold stocks while they're still hated, then it doesn't matter what other actions or manipulations, if you will, there are. Those trades have a very good chance of coming out ahead. But how do you as a TA see yourself competing against these big players?
So for me, the beautiful nature of technical analysis is that it puts you on the same side as the institution and basically opposed to the average investor, right? So let's just use an example here on Bitcoin, right? And when we got down to 33,000 on Bitcoin, I actually put 70% of my portfolio, my crypto portfolio, long cryptocurrencies. It wasn't all in Bitcoin, about 20% in Bitcoin, but I want to show you guys why, right? If we just connect the April high to this high in November, and I'm just going to extend the line out, you'll see in a second why. If we drop an exact parallel line down, look at what you get. You get the exact low here. So now think about it logically. When was the average investor most bullish on Bitcoin? And the answer is when it was here, when it was supposedly breaking out above 65,000. So that was when most small investors, Twitter was filled with it, just crazy bullish sentiment on Bitcoin. Now, when was it most bearish? Right here. And that was when the technical chart hit the level. So my thought process is that by following the charts, for me, all I'm doing is putting the probabilities in my favor, but I'm also going on the side of not the individual investor. I'm actually going opposite the individual investor and likely in the same direction as the institutions for the bounce. Does that kind of make sense? How again, up here you would never follow everyone else because everyone's doing it. So JP Morgan is likely, and I'm not, I don't mean to single out JP Morgan, but institutions as a whole, they're doing the opposite, right? They're the ones selling into that small investor, but vice versa, the small investors starting to panic, they're the ones buying right there.
That's very interesting. And there's going to be a temptation, I think, on the part of some people of, what do you mean you're siding with the evil villains on Wall Street? They're the bad guys. But if you think about what you just said,
right.
I hadn't thought of it this way. Actually, anytime you're being a contrarian, you're likely doing the same thing. You may not think of yourself as siding with institutions. But if you're not going with the investment herd, you're betting against the investment herd. You likely are siding with the institutions.
And that's how I trade. I'm basically a contrarian. When things are crazy bullish, I'm usually accumulating shorts. When they're crazy bearish, I'm usually accumulating longs. I just happen to find levels on the chart that match that same psychological criteria. And I think it's important for every investor to remember that you're not, people fall in love with stocks, right? Tesla and Elon Musk and Bitcoin, even cryptocurrency. But always remember that they don't fall in love with you. your number one priority is to make money for you and your family to have a life. So you never want to commit. And it always drives me nuts when people are like, oh, I just love Tesla and I'm just a full believer. Tesla's not going to turn around if you get on hard times and say, oh, well, here's an extra $100,000 because you loved us so much, right? So use stocks to be your advantage to making money. Don't ever give your heart to a stock or a company.
Yeah, as my friend and mentor Doug Casey likes to say, these are not family heirlooms, these stocks. Particularly in the junior mining sector where I specialize, these are burning matches. So, all right,
so putting it.
I want to ask you about what your charts are telling you about the markets today. But before we go there, one more thing on these patterns. I put up I'm not a TA, but I can see patterns too, right? So I put up a chart last November in the uranium space where you saw this big run up in the fall, and then there was some volatility, and there was what looked like a very clear, I'm not doing this right, a very clear triangle coming together, sort of like the one you showed for gold, but for uranium last fall, where anybody could put lines on a chart, and you would just see this narrowing triangle to the right, and the point of the triangle at the time seemed to be almost touching. And not being a TA, I posted this on my Twitter, and I figure, 15,000 brains are better than one. And I said, hey guys, what does this mean? Do any of you who are good at technical analysis, is it likely to go up or down after the point of this triangle? What does it mean? And it was really striking to see how different the answers I got were. The most people seem to think it was upwards because they said I'm not sure what the technical name for that is, but when a pattern like that resolves, it resolves based on the underlying trend, which is upward for uranium. So most likely that was going to go up. And there are other people saying, no, if you look at it this way, it's asymmetrical, it's not really a triangle, right, and therefore it's going to go down. And you know what? Neither side was right. The pattern is actually extended now. I mean, you could draw new lines and make a new triangle on there and say, oh, it just hasn't resolved yet. But really, if you do that, the tops and bottoms don't touch as well as they did before. And it kind of looks broken to me. So as a non-T, I look at that, and both sides were so sure they were right. And it makes me think, like, how do I trust any of these guys? How do you know in a situation like that what to do?
Yeah, so and that's a great point. I mean, there is so much information out there. A lot of it is not the greatest when it comes to TA. I've come across so many people that don't know the same definition of a head and shoulders, and it's, is it a neckline here? Is it this? I mean, Elliott Wave's the same way. I mean, Elliott Wave is a great thing, but it's so hard to find the people that do Elliott Wave that agree that this is the second, this is this wave, or this is this. They're all like, no, it's this here. No, it's over here, So it's you're right. It is very, very hard. The best thing I can say to people is try out both. You don't want to commit money to anything until you prove it to yourself. Do it, see what the odds of that pattern doing an up move or a down move or nothing are, and then if you see that it works 70% of the time, then think about putting money behind it. But you're right, it is very, very hard. Over years, I think my eye has become trained where I can do this and kind of mostly see the right things. But just like I said earlier, there's many times where it doesn't happen, and you just have to accept that. Remember, it's about putting the odds in your favor. It's not always going to be right.
Yeah, that's why we're having this conversation. People who think they know the future for certain just really irritate me.
I don't blame you. It's crazy.
Unfortunately, they are everywhere on social media, so I spend a lot of time irritated. I'm trying to, practice my breathing, count to 10, be calm, all that stuff.
Exactly. All right, don't get high blood pressure over the internet or over social media.
That's right. So before we move on, did you happen to have looked at that pattern in uranium? I see you've pulled it up on the screen. Do you have a sense for where uranium goes from here?
So I'm not sure. I did pull up the uranium ETF here, and I see this is a beautiful trend line right here, right? So the idea being is that when you have two lines that attack a line, and I didn't trade this, to be honest, but here you have a pivot, here pivot. So when you went up, this would have been your logical place to buy, right? And so far that's worked out pretty well. In terms of the triangle pattern, was it this here, or like I'm trying to think about where it was on the chart you were looking at that.
Like I say, it's a bit broken now.
I'm not sure if you could.
Yeah.
Oh, okay. All right. But one thing I do want to point out is, you talk about fundamentals, and I think it's important to recognize that fundamentals can go hand in hand with technicals. And I think that's something that a lot of technicians are like, no, you have to totally ignore fundamentals. They don't mean anything. But in reality, if you have a long enough time horizon, fundamentals absolutely do mean something. So, for instance, as an investor, I'm someone who's accumulating Facebook right now, right? So I've seen, I wasn't going to buy Facebook up here. I like it when everyone else is starting to hate it, but I'm starting to look back at history and I say, okay, now it's trading at a 13 or 14 or 15 PE ratio, which is a fundamental metric. All right, that's a metric I can get behind. I love the fact that psychologically everyone's hating on it. Oh, there's no more growth. The metaverse isn't going to be anything. So what it's doing is it's setting the bar really low. So if they come out with anything good, it's going to surprise everyone. And then what I like to do is I like to start looking at the chart and I say, okay, well, look at all these pivot points right here and here and here and here, and look at where price is currently. So again, I think it's a beautiful thing to have the synergy between charts as well as the fundamentals. And if you have a horizon of a year or 2 years or 5 years, you're likely going to do very, very well with Facebook.
Well, that is very interesting. Okay. I'll have to think about that, digest that. So, but let's carry on this vein. You've already shared pretty generously of your time, but I'd be very curious to know, what's your hottest chart today, Gareth? Is there anything else that's screaming at you that you like right now?
Well, so there are. I'd love to, if you don't mind, could I just show you the S&P chart just so everyone can kind of get a view on that? All right. So one of the things I do want to point out is that, and this goes to the Federal Reserve, and I'm sure you've talked about the Federal Reserve many times over, but what investors need to understand is that you were in a very long-term trend in the market, and you can see how this market stayed in this trend. And then basically when COVID hit, they came out with these extraordinary measures. We had the government sending us checks here in the United States. We had the Fed, increasing their balance sheet by trillions, QE, 120 billion a month. And basically what it caused was a market on steroids, right? And you can see that, right? I mean, look at this vertical move. And the idea here is, and I want investors to understand this, is that if the Fed is truly going to remove this accommodative policy, then what you should end up seeing is a stock market that comes back into this longer term uptrend. And so again, what that means is that, yeah, sure, we could have bounces. We're up a little bit today on the S&P 500, but I think we should all expect that there will ultimately be more downside if the Fed does continue on their tapering and raising rates and lowering their balance sheet area or policy stance. So just a really interesting longer term chart there.
That is, and even if there's no actual market crash, that's looking at the time ranges on that chart that you've got there, that's basically making a multi-year bear call. I mean, to get back into that trend line.
That's what I've said. I think you'll at least see 20% down on the S&P from the highs this year, which basically gets you down to this high end here. But it's very possible that it wouldn't shock me one bit if we retest the COVID high. This was the high just before the COVID collapse right here. That very well could be. And that's another 100 points down on the SPY, which, that's 1,000 points on the S&P. That would be pretty nasty.
Right. So if that happened in the short term, that would be a crash. If it happened in a more measured way, it would still be a prolonged bear mauling, which would make a lot of people unhappy. So actually on that theme, is there a tool in the TA toolbox that can predict a market crash? Or give you a probabilistic, expectation of a market crash? Looking at that trend line you've got on there, there's no way to expect 2020, but that's, again, it's an exogenous thing. It's a shock from a virus, not from the markets. But say 2008, that was market driven. Are there any tools that can help people, maybe look to harden their portfolios in advance of an event like that?
So for me, I would say in terms of predicting like a crash tomorrow or next week or even next month, I've never found it. Now, is it possible to say, okay, well, I see the writing on the wall where I have this trend and it's now been broken. Now you have a break in trend, which means you're making lower lows and lower highs. So eventually you should go down to this area. So again, I think in you can say, okay, as long as this remains broken, the probabilities dictate that we should go down here. But again, to know the time frame, I mean, that is the hardest thing in the world. I know we've had so many people come out and say, hey, I predict an October crash, or, and it's just like, I mean, how? I've never found it. So I think you can predict a move to the downside with high probabilities, but the timing is just almost impossible. And again, anyone who can, that's amazing. I can't.
Well, that's I appreciate an honest answer there. I can't or I don't know is much better than bullshit, bullshit, bullshit. So I like that.
Yeah.
It's.
But I'll say one thing. You asked me, and probably wrapping up soon, but you were asking me, is there places to be, right? And again, if you look at my market analysis, it's kind of on the bearish side, frankly. So like, where the heck would investors go? I actually do have some areas that I'm investing in. So I'm a believer that as the Fed has been so accommodative for so long, the Fed has caused a lot of money from around the world to come to the United States and invest in stocks, right? And U.S. money has gone into stocks as well here in the U.S., leaving most fund managers very, very underweight in global equities. So the idea is, if the Fed is now not as accommodative, money is likely going to leave the U.S., and you'll go to places, honestly, like China. And I'll show you one chart that I'm starting to really focus in on. Alibaba down from $320 to $125. And this kind of goes to your fundamental analysis too. If you look at the PE ratio of this company, I mean, it's like 15, and you have Amazon at a crazy valuation, and you have this trend line here that if you can break this trend line, you break the downtrend and you could actually see some upside. So, there are places to invest. Generally, right now, I'm looking outside of the United States.
That's very interesting, because we hear that actually a lot. I hear it on Bloomberg, and one of my fellow Puerto Ricans here is really big on emerging markets. But not all emerging markets are created equal. And every time I hear that, I always think, yeah, but it's Bolivia or Argentina,
right,
or whatever. Like, that doesn't make me comfortable. Just the fact that it's not the United States doesn't mean that a place that's been a basket case economy for years or decades is suddenly going to somehow be a safe place for money. So how do you choose in an environment like that?
Yeah, so the best way to do is allocation, right? So I'm a big believer, and I do this in my portfolio. It's one of my early mistakes in my career, and I, for everyone that doesn't know, I was that average investor who did stupid things so many times and lost so much money. Thank goodness I didn't have a lot of money when I first started investing, but my first initial amount was $10,000. I blew that up multiple times, having to work my butt off on side jobs to replenish it until I finally learned how to do things properly. One of those things is allocation, right? So as your portfolio grows, you're right. There's risks in Bolivia. There's risks in Brazil. There's even risks in China. And you should never fully allocate a portfolio to any area. So I'm allocated right now. My biggest position is probably gold, some China, and then some other maybe some beaten down tech for just a quick swing trade. But then I have spatterings of other investments around the globe and in the United States as well. And again, allocation, if one doesn't work out, at least it's just a small percentage of your portfolio.
All right. Let me take a step sideways then before we wrap this up. Do you ever apply this sort of TA to non like equities prices or bond? I guess you probably look at bonds too, but other things like do the same rules apply to, say, looking at CPI on a chart or economic indicators like that? And is there anything to be learned from what those charts are telling us now?
Yeah, I do think there is. You can chart anything that can be charted, or anything that is in chart form, you can look for things, right? So even like the 10-year yield, I mean, the 10-year yield can absolutely be charted. And if we bring up this, let's do that right now, the 10-year yield. And let's see, there we go. All right, so you can see we've had this big move up, and it looks like I have a trend line in here already. Let's go up to the weekly and see. But you can see that there's a level that we're coming to on the 10-year, which tells me that once we get there, then the Fed either is going to back off from hiking, maybe the economy suffers too much, or maybe the stock market is down too much, but that would likely be your short-term high, at least over the next 6 months or so. So, according to this chart, looks like we still have upside to about 2.4%, 2.5%, but once there, you would absolutely expect a pullback in yields. And what's nice about that is it gives you an idea of what to invest in.
Sorry, but wait a second. Wait a second, Gareth. Unless the Fed is engaged in covert yield curve control, I mean, you're looking at the 10-year there. That's not the Fed funds rate. So, and they haven't moved the Fed funds rate. So right. That uptick at the bottom right of your chart, I mean, that's not the Fed in theory. So, I mean, what are they going to pull back? They haven't even started yet, right? So, right. Are you saying you don't buy the theory?
It's not the Fed. But the bond market absolutely interprets what the Fed is doing and going to do, and they move interest rates accordingly. So it all kind of comes, just like a stock. You'll see, and folks will probably know this, is like before anything happens, just like we were talking about with gold. Gold starts to move even ahead of time, right? So if you could even look at the gold move from 2018 to 2020, that big move up, likely it was anticipating the inflationary bump, and now it's gone into consolidation mode to the next breakout. So I would just say that, again, the bond market is the biggest market out there. It's massive. The traders, the bond market traders, are so smart. They see the writing on the wall, essentially.
Very good. Okay. Well, you've been quite generous with your time. I don't want to take too much more of it. I'll just first thank you for the education. This has been really interesting. I will have to give it some good hard thought, what you've shared today, and leave you with the last word. Anything else that you want to make sure that any investor out there is aware of today?
I think just to be prepared for more volatility, right? I mean, the Fed is basically taking the punch bowl away. I've likened it to a kind of a drug addict, and the Fed has been the drug dealer and just pumping and injecting more and more money into the system. Now the Fed is pulling those drugs away, so it only makes sense that the market goes into some sort of withdrawal. So be very careful. Expect bigger moves than you think, both to the upside and the downside, and play it safe. There's nothing wrong with having some cash on the sidelines or some investments in gold. It may not be super sexy, but if it saves you from big losses, that's awesome.
All right. Well, thank you so much, Gareth. We appreciate it, and let's keep in touch. Let's see how these charts work out for us in a few months.
I would love to do that. Thank you so much for having me.
Thank you for watching this edition of In the Pit with Lobo Tigre. If you enjoyed or found value in what you just saw, and you're watching this on any sort of social media, please do hit the like button and the share link. Send this on to anybody you think might be interested. That helps us out a lot. If you're watching this on YouTube, please do hit the subscribe button as well. The number of subscribers helps us get more valuable content to you as well. On the subject of subscribing, I'll quickly say that if you're not a subscriber to our free weekly Speculators Digest, I encourage you to sign up. I promise if you do, we will not send you a flood of daily advertisements. You get one free weekly digest with original research not published anywhere else. Check it out at independentspeculator.com. Thank you and have a great day.